Welcome to the Wealth Studying Podcast. This is episode 467. Today is April 13th, 2025. I'm your host, John Pugliano. I'm also the founder and money manager at investablewealth.com. Well, today I got a different way of presenting the podcast. We'll get to that in a minute. The real takeaway of today's episode, though, is that I simply want to reiterate what I said in the previous episode. Now, I know there's been major market movement over the past couple weeks. I haven't addressed that because what I had previously said, I still think is playing out. Now, we did drop below the double bottom base that I had talked about in the last episode, but I had put a caveat in there to say that watch to see the lower level. We most likely wouldn't get below 5,000 on the S&P 500, and if we did, to me that would be very concerning, but unless there was some kind of big black swan event, that 5,000 level would probably hold. Well, we did get slightly below that for, some intraday trade. But bottom line, pretty much, as close as can be expected, that 5,000 level did hold. And when that drop happened, we saw some major capitulation selling, which is, again, what I talked about last time. I said we hadn't seen that yet. During that capitulation selling, we also, as you would expect, had a huge spike in the VIX. I see all that as encouraging because, again, we didn't drop significantly below that 5,000 level. In fact, the capitulation selling was followed by a big buy the dip momentum. And again, that was something that I had said we need to watch for because we hadn't yet seen that in this double bottom pattern that had been playing out. So, yes, we have now gotten the capitulation sell-off. We did get the big buy the dip. But, and here's the big but, what we haven't seen is any, or at least what I would consider, any major follow-up to that initial buy the dip. Now, the market has raised significantly above that bottom level. We're currently trading over 5,300, which is moving in the right direction. But I think we still need some more trading days where we see not only a continual movement upward towards that 5,500 and hopefully onward to 5,700 or more, but also we want to see that with some above average trading volume. So watch for that. But in the meantime, again, I want to reiterate what I said in the previous episode because it all applies. And I'm going to do this in a different fashion because what I found interesting about the last episode was when I continuously replayed that clip of President Trump. I'm not going to replay it. You know which one I mean. The vast majority of my listeners really like that, based on the feedback I've received. But this is interesting. There was a minority of people that were upset, or not upset, but didn't like the fact that I did it. Here's the catch, and here's what's really interesting about it. About half those people that didn't like it were mad because they thought I was mocking President Trump, and yet the other half of the people, they were mad because they thought by replaying it over and over again, I was reinforcing Trump's communication style and I was agreeing with his policies. Well, whenever I get feedback like that, I go back and listen to the episode. And in fact, I listened to that one several times. And you know what? Every time I listened to it, I laughed harder. Because I wasn't mocking President Trump, nor was I trying to promote his policy decisions. I was simply trying to use my cynical, sarcastic humor to get across some complex points. And not only did that episode make me laugh, but when I checked some statistics using artificial intelligence through Google's trend tracking, there were also some pretty interesting patterns that came out about that. I won't get into all that, but what I found was interesting was the reaction to that podcast. And so I took that episode and I ran it through Google's Notebook LM. If you don't know what that is, you should become familiar with it. It's got a lot of great features, but one interesting feature is that it will create an audio podcast for you based on the information that you plug into it. So I took the previous episode, I plugged that into Notebook LM, and I wanted to see what AI would generate from it. And I think they did a pretty good job of capturing the message that I put out, which again, I think is important. And so to reiterate what I stated in the last episode, rather than me grinding it all out, I'm going to play for you the podcast that Google Notebook NL generated. So here it is in its entirety.
Welcome to the Deep Dive. If you've been watching the markets recently, it probably feels like a bit of a roller coaster, right?
Definitely. Lots of ups and downs, a feeling of uncertainty, maybe.
Exactly. And look, you're smart, you follow this stuff, but you want to cut through the noise, understand what's really going on without drowning in headlines.
Absolutely. It's about getting that deeper signal, not just the constant chatter.
And that is precisely our plan for this deep dive. We're going to dig into some audio analysis from March 30th, 2025. It features John Pugliano from the Wealth Studying Podcast.
Pugliano, yeah. He's got this knack for, slicing through the immediate news cycle stuff.
He really does. He looks at where the data, the fundamentals, might be saying something different from the big splashy headlines.
Cutting through that media noise, essentially.
So our mission here is to pull out the core insights from Pugliano's take, give you a clearer view of what might be influencing the market beyond, the latest tweet or press conference.
Help folks feel a bit less overwhelmed, maybe, and get a more grounded sense of this current volatility.
Okay, so let's get into it. Pugliano kicks things off by talking about something that's, hard to ignore, the Trump factor.
Right. He points out how often market moves seem to pivot on what President Trump says or is expected to say.
It's become a familiar dynamic, hasn't it?
Very. And Pugliano really emphasizes the sheer unpredictability there, how statements can shift, sometimes really quite fast.
Yeah, and the market seems so sensitive to those shifts. It's kind of fascinating.
It is. And Pugliano actually used a specific audio clip to make this point really vivid. It was President Trump saying, "Oh."
Oh, I remember that one. Did I say that? I can't believe I said that. Next question.
That's the one. It's pretty memorable.
And Pugliano uses it to basically highlight the uncertainty this injects. How do you analyze short-term market moves based on something that might change tomorrow?
Exactly. Now, we should probably mention some listeners interpreted that clip differently. Some felt it was maybe a bit mocking.
Right, while others felt it just sort of underlined the changeable nature of the statements themselves and how tricky that is for markets.
Pugliano's point, though, seemed less about taking a side and more about illustrating that very difficulty, the challenge in evaluating those short-term signals consistently.
Which leads him to an interesting perspective, almost a silver lining, maybe.
Kind of, yeah.
Yeah.
He suggests that because these political statements can be so unreliable, maybe the best approach is to, discount the immediate media narrative a bit.
Whether it's pro or con Trump, basically ignore the churn.
That seems to be his angle. It ties into one of his core ideas, his wealth-building principle number 8, about identifying propaganda.
Ah, okay. So seeing through the spin, the noise.
Right. He argues that with so much contradictory information flying around, you have to try and see the underlying reality.
His main argument seems to be that the bigger, longer-term trends in the market will likely play out regardless of the day-to-day political talk.
Yeah, he often frames it like the underlying economic and social forces are the big drivers. And politics often reacts to those, rather than the other way around in the long run.
But importantly, he does say that, policies and actions do have effects, even if they're maybe not always what was intended or expected.
He gives that example of European defense spending, Germany in particular.
Right, Germany committing to significantly boost spending, even taking on debt to do it.
And Pugliano sort of poses the question, would this have happened without Trump's, let's say, chaotic approach to NATO? Previous presidents pushed for more spending too, but didn't get the same result.
It's a fair question, though Pugliano himself notes it's debatable, the direct causality.
Sure. But here's where it gets really interesting, as you said.
The German market performance. Despite all the talk about tariffs hurting global economies and the U.S. market pulling back.
Their market showed relative strength. Pugliano found that pretty paradoxical. Like, how can the German market be doing okay if U.S. policies are supposedly so damaging globally?
It definitely makes you think about how complex these global connections are. Maybe unexpected resilience in places.
Could be. But Pugliano quickly pivots from that immediate puzzle to what he sees as much deeper, more fundamental problems in Europe, especially Germany.
Yes, moving beyond the politics to the underlying economics. He lays out 4 big ones.
First up, demographics.
Yeah.
It's not a new issue, but the aging population. Not enough younger workers.
Yeah.
That's a long-term drag.
Then number 2, their energy system. He sees it as fragile.
Very reliant on imports, high costs, especially after, the Ukraine situation really shook things up. Huge pressure on industry.
Which ties right into the third point, that declining industrial base.
Exactly. Losing export ground, especially to China, and getting squeezed by those high energy costs. have to compete.
And the fourth one he hits on is the lack of a really dominant tech sector.
Yeah, you look at the big global tech players, very few are European. That's a major gap compared to the US and Asia in terms of, that modern growth engine.
And the key thing Pugliano stresses here is that these aren't just like recent problems tied to current politics.
No, these are deep, structural, long-term challenges Europe's been facing for a while. So while the political noise is loud, these underlying issues are arguably more important for the long haul.
Okay, let's pivot back across the pond then to the US market. Pugliano's looking at the charts, specifically the S&P 500. He sees a potential pattern forming.
A potential double bottom, right?
Can you quickly explain what that means for folks maybe not glued to charts?
Sure. Think of the letter W. The price drops, finds a low, bounces up a bit, then drops back down to roughly that same low level again, and then starts to rally more convincingly. Technical analysts see it as a sign a downtrend might be reversing.
And Pugliano points to specific levels to watch. That first low, around 5,500 on the S&P.
Right, that's the first potential bottom. Then the bounce creates a peak in the middle. He calls it the apex, around 5,750.
Which is also near the 200-day moving average, he notes.
That apex level is key. A strong break above that 5,750 level is what traders look for as confirmation that the W pattern might be playing out, signaling potential further upside.
He also mentioned the 50-day moving average, around 5,800, as maybe the next target if it does break out.
Potentially, yeah. Though often for a really convincing double bottom, you'd want to see trading volume pick up on that breakout move above the apex. Shows conviction.
Now, despite this recent pullback, Pugliano sounds somewhat constructive. He doesn't seem to think the fundamentals justify a huge crash from here, say, below 5,000.
Yeah, his view seems to be that based on what we know now about corporate profits pending Q1 results, of course, things haven't totally fallen apart fundamentally.
So that 5,500 level holding is pretty crucial in his view.
It seems that way. Cautious optimism, maybe. Acknowledging things could go wrong, especially with, unexpected political events.
And talking about market behavior, he made an interesting point about trading volume during this dip. It's been low.
Lower than average, yeah. Which, you can read a couple of ways.
Okay, like how?
Well, on one hand, low volume on a decline can mean there isn't widespread panic selling. It's not like everyone's rushing for the exits.
So maybe less fear?
Possibly. But, as Pugliano points out, the flip side is it also suggests there isn't a huge rush of buyers stepping in either. No strong conviction to buy the BIP, perhaps.
So a bit of apathy, maybe. Lack of strong feelings either way.
Could be interpreted that way. It's a bit nuanced. He also noted the VIX, the volatility index.
Right, the fear gauge.
It hasn't really spiked dramatically despite all the negative headlines and uncertainty.
Which he sees as another sign we're not in, full panic mode.
Exactly. Usually in a real market meltdown or capitulation, the VIX goes through the roof. The fact that it stayed relatively contained suggests maybe some underlying stability or at least not extreme fear.
Okay, now shifting to some more positive signs Pugliano mentioned. He sees strength beyond just those few mega-cap tech stocks, the Mag 7.
Yes, this is quite important. He highlights the equal weight S&P 500 outperforming the regular market cap weighted one.
Explain that difference quickly.
Sure. In the standard S&P 500, giant companies like Apple or Microsoft have a huge impact because the index is weighted by market size. In the equal weight version, every company, big or small, counts the same.
Ah, okay. So if the equal weight is doing better.
It suggests more stocks are participating in the market's performance, not just the very biggest names. It indicates broader strength.
Got it. He also mentioned mid-caps looking relatively strong.
And small caps. The Russell 2000. Now, they've had a tougher time, down quite a bit already, almost bear market territory.
But he sees something positive there, too.
A potential double bottom pattern forming there as well, right near its long-term moving average. And he often views small caps as a potential leading indicator for the rest of the market.
Interesting. And he also pointed out that some sectors, like industrials, materials, mining, they started declining before the latest tariff talk really heated up.
Right, which suggests maybe it's not just about tariffs, but also about the regular ebb and flow of the business cycle affecting those more traditional economy sectors.
Okay, let's touch on the economic data points he discussed. He sounded a bit skeptical about that Atlanta Fed GDP forecast.
Yeah, the GDP Now model. It was showing negative growth, which seemed quite pessimistic compared to other forecasts. Pugliano questioned if maybe some quirky data, like gold imports, was skewing that specific model. hinted it might even be politically influenced, though that's obviously speculative.
He also wasn't too fussed about the minor wiggle in the core PCE inflation number.
Right, like a 0.1% difference between expected and actual. He basically said it's statistical noise, could easily be revised. Core PCE is that key inflation measure the Fed watches, stripping out food and energy.
And he contrasted that inflation worry with the bond market, the 10-year Treasury yield.
Exactly. It had actually come down significantly from its peak earlier in the year, hovering around 4.25%. He argued that if bond investors were truly terrified of runaway inflation, yields would likely be much higher.
So the bond market may be telling a different story than some headlines?
That seemed to be his take. His longer-term view sees inflation settling in a sort of 2 to 3.5% range, partly due to bigger shifts like globalization changing and Chinese labor getting more expensive. He sees the current 10-year yield as fairly reasonable within that context.
Okay, so wrapping up his overall assessment, he finished by comparing the fundamental strengths of the U.S. economy versus, say, Europe.
Yeah, he came back to those core advantages. Demographics first, the U.S. has a decent-sized millennial generation, plus the ability to attract talent globally, unlike Europe's aging issue.
Then energy. He sees the U.S. as a powerhouse.
Absolutely. Strong in fossil fuels, but also huge potential in nuclear down the road, and obviously lots of natural gas, much more secure than Europe's situation.
And then, of course, technology. Still dominant.
Yeah, despite occasional worries about competition, like that brief buzz around China's DeepSeek AI model, the U.S. tech sector remains the global leader by far.
And finally, manufacturing. He acknowledged it's been weakened historically.
But he thinks it might be bottoming out. And there's this renewed focus on bringing some industry back, which he sees as strategically important. Even if Trump's tariff approach seems, as he put it, haphazard, the underlying goal aligns with efforts from past administrations, too.
Okay, so let's try to sum up this deep dive into Pugliano's thinking. We heard how political noise, especially unpredictable statements, can really stir up short-term market volatility.
But Pugliano advises trying to look past that daily churn, focus on longer trends, and be wary of getting caught up in every headline identifying that propaganda, as he calls it.
We also looked at the contrast he draws, the deep structural economic headwinds facing Europe, particularly Germany,
versus what he sees as fundamental strengths in the U.S. economy: demographics, energy independence, tech leadership, and maybe a manufacturing base starting to stabilize.
And technically for the U.S. market, we talked about that potential double bottom on the S&P, the meaning of lower volume, and those encouraging signs of broader market strength beyond just the tech giants.
Hopefully for our listeners, piecing this together shows how looking at these different layers, the political, the fundamental, the technical, gives you a much more, nuanced picture. It's not all just about the latest news alert.
Right. It's less overwhelming when you see the different forces at play.
And maybe it prompts some thought about that balance. How much weight do you give short-term reactions versus those longer-term economic tides? How do those different time frames shape your own understanding?
A good question to ponder. So we'll leave it there for this deep dive. And as Pugliano always signs off, until next time, best return.